Hello, everyone. Thank you for joining us. We're going to give just a minute here for the everybody to get into the call. Looks like we're taking off. Everybody's joining us. Beautiful summer day here in Colorado. Hope everybody else is enjoying some wonderful weather and a productive week. All right, well, let's go ahead and get started. Hello, everyone. My name is Daniel Leifeld. I am the Director of Business Development for Key Data Dashboard. And with me today is Vishal.
Hi,
Introduce yourself,
everyone.
Vishal.
Hi, good afternoon. My name is Vishal. I'm the founder and CEO of HostAllies. Over the last decade or so, I've been involved in short-term rental property management in various capacities. As an investor, managing my own portfolio, as a property manager, managing properties for others, and now as a provider of accounting and financial management services to this industry. And I'm so excited to join Dan to discuss how visibility can drive growth.
Go ahead and head on to the next slide. For those of you who don't know everything about Key Data, we're a business intelligence and market intelligence solution for the vacation rental industry. We collect our data directly from property managers and their property management systems. That's our unique selling proposition at Key Data. The thing that we have that others don't is the direct source data. We directly connect with over 80 different property management systems and over 16,000 property managers. That allows us to pull in data every 12 hours directly from those property management systems, data from over 1.7 million listings. That means that we can see some things that others can't, things like owner stays, maintenance holds, blocks, cancellations, owner stays, or owner metrics. The list goes on. But one of the big things that really applies here today is the ability to see even different types of revenue because we can see the base rate of a property. We can see the other revenue that people add on top of their reservation, and then you can see the combination of both. So it gives you a pretty holistic view of the revenue that's coming into your company. And that allows us to provide you with real-time business intelligence and market intelligence tools for property managers. We work with, like I said, over 16,000 property managers worldwide, and give you the ability to measure over 45 different metrics. So, an absolute ton of different data metrics that you can measure. And all of that goes into what we're going to talk about here today. Vishal, why don't you tell us a little bit more about HostAllies?
Sure. I wanted to start by a quick introduction to the genesis behind HostAllies. As I already told you, I've spent years in property management, and I've gained the first-hand knowledge of the challenges property managers face in accurately managing their finances and driving visibility to their business results while they're trying to grow their business. And there are two reasons for it. First of all, property managers have very important things to do, like taking care of guests, managing the health of the properties, acquiring new owners to grow their inventory. With all that's going on, there's not enough hours in the day to focus on back office tasks like bookkeeping and finances, right? Secondly, back office accounting and financial management is can be really complex and time consuming, and it does require specialized skills. That's why we built Host Allies to help property managers manage their back office so that they can focus on their front office. This way, our clients can help grow their business and we can provide them with the tools and reporting to ensure that they're doing it in the most profitable manner. This slide just talks about the slew of services we offer. We do everything from trust accounting to lodging taxes to automating how expenses are managed, income taxes. And we serve multiple short-term rental firms all the way from 10 properties to 200 properties and select large franchises. And all of that experience is what we are here to share in this webinar. And I'll hand over back to Dan so he can introduce the topic of today's webinar.
For sure. Thank you, guys. No, thank you, Vishal. When we get into how we kind of work together here with Host Allies, is we know that you guys want to grow. Everybody, it's the number one thing that we hear, and every call that we hear with every partner that we have here at Key Data is that everybody's trying to grow their inventory. Now, you have to be able to see where the opportunities lie within your inventory, especially when it comes to the conversation between revenue and profit. And we want to make sure that you're making money, not just making revenue. You're actually profiting from that revenue as well. So that's how we're going to get to it today. Go ahead and go to the next slide here, and we'll jump into all the things that we're going to talk about today. The visual opportunity that you have, we're going to translate a little bit with the bottom line. Vishal's going to talk about that really specifically, along with the ratios that you got to be looking at, and then we're going to give it all to you in a nice wrapped up box with a ribbon. So let's go to the next slide and jump into the profitability flywheel. Now, this is something, I love this visualization because it really helps us understand kind of how we need to get through all the data that's at our fingertips today. Everybody's got data all over the place. This is hopefully going to help guide people through how to start with that decision-making process. So when we talk about market intelligence, it's really important to look at really accurate data. That's what Key Data specializes in. We directly connect with the property management systems and pull data in. That allows us to see things that others can't, like I mentioned, owner stays, maintenance holds, blocks. Kick those numbers out of the equation for certain reasons and bring them in for certain reasons. Understanding exactly what's going on within your own inventory is really important, but understanding what's happening in the market level is just as important. And we can see those same things at the market level and bring those to the forefront so that you can say, oh, well, we're not the only ones with high owner usage during this time. Or, hey, let's compare our performance for concierge services to the rest of the market. Those are the types of things that you can do within key data. And kind of the starting point for where you should be looking at. How is my ADR, occupancy, and RevPAR compared to the market in general, right? So we start pretty high level. But then we need to be able to make really good revenue decisions. And that is to be able to really dive into each of those individual metrics and say, okay, our ADR occupancy is higher or lower than the market. And then we go to the RevPAR discussion. RevPAR, for those who aren't currently measuring it, stands for revenue per available rental night. It's the single most valuable metric that you can measure in any lodging system. In the vacation rental industry, it's a very big deal that you can kick out owner stays, maintenance holds, and blocks from the equation because if you don't, you're really getting a skewed number. And so RevPAR really matters because it kind of it ties ADR and occupancy together into one metric that tells you if you're actually making more revenue with that strategy or less. That takes us to where we can start to look at cleaner property level financials. So when we talk about RevPAR, you want to be able to segment your inventory into different property types with different attributes. We're going to talk a lot more about that in a little bit. Then that's going to give you the ability to have to get into HostAllies solution and really start looking at the margin visibility, right? Seeing which property types, which properties are actually winning or losing, and then looking at your RevPAR, just to go back, bringing it all together to see which properties are actually at risk, right? Like you can be making more revenue this year, but it's still costing you money. That's where the accounting side of things comes in. And that allows you to have smarter portfolio optimization so you can bring in the right properties that are going to actually fit with your model to make you money. And then we just continue to look at the data all over again and bring it all the way back around. So let's go to the next slide. And let's talk about opportunity visibility. Now, Within key data, you have the ability to look at your portfolio and compare it to the market. And then you can even tier your portfolio performance. You can see, okay, what do I look like versus the top 10% or 50% of the market? We have the ability to kind of see where do I fall into the grand scheme of things in the market? How do I stack up? You can identify which individual types of properties you are actually performing well. You can look at it versus your own portfolio and versus the market. And then you can really see where the revenue is leaking, right? So, which types of properties, which areas, which amenities are actually costing us, or excuse me, are actually bringing down our performance, right? So, who's under the line if you look at it that way? And you can look at that for ADR, occupancy, RevPAR, over 45 different metrics, but those are the big three. We get into things like average length of stay, even, which are insanely valuable to understand. Are people staying shorter time periods? Are people booking further out or closer in? To be able to understand all of those different metrics allows you to get into the decision-making process when it comes to an accounting perspective. Let's go ahead to the next slide. This is where we can really shine because we can start to dive into all those different attributes and understand how the properties with those attributes are performing for all of the different metrics. Think about this like in this example, we've got luxury homes or budget homes or condos or cabins, and putting that all together so you can see which properties are actually performing above the market trend, which ones are at market trend, and then which ones are below market trend, right? So being able, one of the things that I always caution people about though is when you look at the market average, I don't love averages, and anybody who hears me say speak ever knows that I always say averages suck, right? And that's because there's some things that are below average and there's some things that are above average, and being able to separate those out is really important. Now, your homes, your properties have are going to have, let's say that you're 20% higher in revenue this year. That's great. That's awesome. But let's focus on those ones that are below average so that we can go say, these are the properties that need to pick it up. There's something wrong with these properties. And sometimes it's not something that you can fix, it's something that you have to cut. And so those are the types of properties that we can help you identify by saying, okay, it's these specific properties that have low RevPAR. And it's the ones that have certain amenities or certain attributes like, oh, well, they're not quite oceanfront or they don't have a hot tub. Those are the types of things that we can help you uncover to see if it matters. Maybe there's some properties that are actually performing and they don't have a hot tub, while properties that aren't performing have a hot tub. So there's all kinds of different things that we can help you kind of segment your inventory and see which amenities matter, which attributes matter, and go from there. Let's go on to the next one. And that allows you to say that segmentation allows you to make better decisions because you can really understand, um, you know, is there a huge RevPAR difference between certain bedroom counts? We see this a lot in some markets where there's, very big properties and then properties that are kind of mid-sized and then smaller. Does it make a difference if they're an 8 bedroom or a 9 bedroom or a 10 bedroom? Sometimes a 9 bedroom will perform worse than an 8 bedroom because it's an odd number. For some reason, that makes a difference. But the different being able to segment your inventory and look at the data for those different segments allows you to kind of spice up or bring up, boil up some issues within the data. That way you can red flag it and say, hey, let's not look so heavily at these things, but let's look at the things that are actually bringing us down. It also allows you, if you're operating around the world, to segment your properties by location. So there's a lot of companies these days that operate in many different markets. This allows you to segment your data by market and then drill into how each market is performing and which amenities matter for each market. So segmentation is key to understanding where you can find revenue opportunities. Let's go to the next slide. So here's what the winning operators really do. They use that benchmarking to guide their pricing decisions. They segment their inventory deeply. It's not just segmenting it house condos versus homes. It's saying here's large houses, medium houses, small houses. And then here's within the large houses section saying here's 12, 11, and 10 bedroom houses. Being able to segment your inventory really matters and segmenting it deeply. And then track your performance at the property level. So once you find the properties that are the segments that are doing worse than others, you can then get into the individual properties and which ones are dragging everything down. And then they combine their operational data and which comes in.
Excellent transition. Can you hear it?
Yes.
Can we, so now, first of all, thank you, Dan, for setting up the profitability flywheel. And thank you for sharing about the best practices on how to capture growth and opportunity. I think that's really critical for the success of any short-term rental operator. In my section, I'll be focusing exclusively on how to effectively manage your bottom line. But I want to start with some foundations. I want to show you that how you set up your accounts and financials can make a big difference in how effectively you can manage your bottom line. Now, this particular slide shows you two common but divergent paths that property managers take. Stay with me as I walk you through it. Let's think of two operators. They have the same size business. They're generating $1 in terms of revenue from a guest. But now, depending upon how their accountant has set things up, their profit and loss could look completely different. It could be harder or easier to understand, harder or easy to interpret, and harder or easy to manage. So let's walk through the top path. This is called the trust path. This is a path one where the guest pays $1, the OTA fees are deducted, the payment processing fees are deducted, and 90 cents of that dollar actually enters a trust account. Now, all of those guest dollars are hitting that separate trust account. From that trust account, the cleaners are getting paid. So the cleaning fees, other property expenses are getting paid. The owners also get their share of rentals and fees from that trust account directly. And then what remains is that 30 cents of that dollar, which is the gross revenue for the property manager. And in the trust accounting path, that is then deposited in a separate operating account. And from there, the operating expenses or the overheads are spent. And ultimately, it's a net operating income of 12 cents. Now, let me walk you through this other path, which is the commingled path, path two. Here, all the money that the guest is paying hits your main business account. So it looks like your revenue is huge, but it is almost an illusion because you have to write massive checks from that account to the owners, to the cleaners. And your 30 cents of gross revenue that the property manager has made is somewhere buried in there. But your P&L looks completely different because it's drowning in money that was never yours to keep. Now scale this up from this $1, one example, to a property management company that's managing $1 million in gross bookings. The P&Ls could look wildly different. In the trust path, the operator will show a gross revenue of about 300,000, right? But in the commingled path, it'll show a gross revenue of about 900,000. So same business, same end profit, completely different books. If you're trying to benchmark one of these operators against each other, you're comparing apples to lawnmowers, right? But this definitely matters because think about if you're doing the commingled financials, think about the amount of complexity you can add. And I'll talk through it on the next slide and a few following slides. So now let's think about it this way. Either way you do your accounting or finance, you have to capture and understand where the 88 cents went. So what we know is for if a guest pays $1, on average, the net operating income for the property manager is about 12 cents. So where does all of this money, 88 cents goes? Because right now it looks like that you're acting like a free bank for everyone else. So let's walk through the waterfall. And this is the waterfall visibility that we are recommending you drive in your business, right? So guest pays $1. Right off the top, you might lose 10 cents in platform fees and payment processing fees before even the money hits the trust. In some cases, the channels don't actually deduct the platform fees. They send you a separate invoice. And if that is the case, you have to recover that money from the owners. Otherwise, it's going to hit your bottom line and it's going to hurt you really badly, right? Then let's talk about the 90 cents that actually arrives in the trust. Out of that trust, the owner is getting their share. That might be their nightly rate. The lodging taxes, if you're holding it on their behalf and then remitting it to them. Any property expenses that were paid from the trust. And what is left is your fee revenue, the 30 cents. That's your management fee. That's your ancillary fees that you're charging the guests. That's your cleaning margin, hopefully some maintenance margin. But that's the only number that actually reflects the true size of your business, not the vanity gross bookings number, not the 90 cents that hit the trust. The 30 cents is that's actually yours. And from those 30 cents, operating expenses typically take 18 cents. That could be your software, it could be your team, marketing, overhead. So what is left is 12 cents. Now, most operators are trying really hard to grow by adding doors. But if you're operating at 12 cents on a dollar, there's tremendous of bottom line growth you can achieve by just managing the 88 cents better. And that's the visibility that we are trying for you to think through. Because if you can manage the 88 cents better and the 88 cents suddenly becomes 80 cents, then you went from 12 cents in profit to 20 cents. Or from $120,000 on $1 million portfolio to $200,000. So that really matters. That's why understanding this profit waterfall and the revenue and the expense aspect of it is critical, and managing them well is critical. So let me take you to the next slide, which will just focus on the revenue first, right? Now, this is a slide that most operators never really sit down and think through. Not all the revenue that shows up on your profit and loss statement is the same kind of revenue. Some of that revenue is 100% yours. Some of it is yours in name, but it really belongs to somebody else. It's a pass through, right? And some of it should have never been on your books in the first place. And if it is, then there's an accounting error. So I'm going to walk you through not every row, but I'm going to walk you through some specific areas that matter the most. But this slide is obviously available for your reference later. So let's start with management and booking fees. This is your core operating revenue. 100% of that is yours. Unlike cleaning fees or lodging taxes, this isn't money you're legally obligated to hand over to somebody else. It's the baseline revenue meant to cover your corporate overhead and drive your actual business profit. This is the line you protect at all costs. Now let's think about cleaning fees. This is the trap. The full cleaning fee charged to the guest looks like revenue, but your gross revenue is only the margin, the difference between what you actually charge and what you end up paying in cleaning expenses, your cleaning vendors, your in-house team, what you pay for the supplies. If you're charging 150 and you're paying 145, your real revenue is only 5. So most operators don't track it that way. We'll come back to this because it's a silent killer. Third thing I'll talk about is lodging or occupancy taxes. This is where operations get into trouble. This is 100% passed through to the government. It's not yours. It should never appear in your operator P&L. And if it does, you have a problem for accuracy and for compliance. And one last thing, look at these rows here, like guest ancillary fees, owner administration fees on the table on the screen. In a well-run set of books, these are very clean. They are explicit line items that you can price, you can benchmark, and you can defend. In a bad set of books, everything in this gets dumped into a junk drawer called the other fees or miscellaneous revenue. And that generic catch-all is a real red flag. It's invisible. You cannot optimize it. You can't control it. You can't benchmark it against competitors. Or if an owner asks you about this, you are not be able to defend it. So it's really important to set the accounting right. And the other key question that you have to ask is, you have most property management companies have a lot of pass-through revenue, right? Are you actually collecting all the pass-through cash, right? Are you getting reimbursed for the expenses that are pass-through expenses? Are you keeping your fair share of profit in that, right? So if you cannot answer that with confidence, then your books need a lot of work. So this is the 50% of the side of your profit waterfall, which is the revenue. Now I'm going to switch over to the other 50%, which is expenses. Now, this is where your margin goes to hide. So what happens is, let's talk about the four main buckets. Cleaning. We already mentioned, but it's worth repeating. The question is simple. Are you making money on cleaning, or are you subsidizing the guest experience? Most operators are shocked when they actually add up and do the math. And we will quantify this in a minute in our dashboard that we want to share with you. Maintenance and repairs. This is another big question. The question here is, who's actually paying for the maintenance? Routine maintenance, vendor markups, recurring services like lawn and pool services. A lot of these costs should be owner funded by the contract, but end up being absorbed by the operator because they have not been categorized correctly, because the accounting, the foundations have not been set up. This is definitely worth a quarterly audit on your maintenance line. You need to be able to dig through this and say, are all my maintenance expenses, how much of that have been reimbursed? How much of them are owner related? Or is my maintenance revenue higher than my maintenance expense? Finally, overhead and administration. Marketing and acquisition. This is the one operators most underestimate. There is OTA boost spend, direct booking spend, photography, paid ads, listing optimization tool. What does a booking actually cost you? If you don't know your blended cost of acquisition, you're flying blind on the direct versus OTA strategy. And finally, overhead, software, team, insurance, processing. The question is, what is your true cost per property to operate? Because if you don't know that correctly, you're not going to be able to price your management fees correctly to be able to make a profit. And then there's a real bigger trap in all of this. When you look at your P&L, when you look at your profit and loss statement, there's a cost of goods sold, and there is a operating expense section. Many times these expenses get miscategorized. Sometimes channel fees get buried in the overhead. Sometimes owner-funded repairs are hitting your books. Sometimes cleaning labor becomes an administration fee. The wrong buckets equal to wrong margin equal to wrong decisions. When I reviewed new client books, this is one of the first things we look for. Did get this right, and your profit and loss statement starts telling the truth. So let me show you what this looks like in practice. I'm going to walk you through a real case very real experience we had with a client. It's about a 50 plus property boutique operator. When they came to us, their books couldn't keep up with their portfolio. Their owner statements were chronically late. There was no structured trust accounting process. They were commingling firms. And their margins were eroding across channels, and they couldn't pinpoint why. Does this sound familiar? This is a most common story we see for property managers of this size. What we ended up doing with them is we reconciled their trust account. We created and reconciled their trust account balances. And then we corrected the proper transfer amount. Uh, this alone helped us identify $50,000 that was sitting in the wrong place. We then streamlined the expense and owner charge process with a clear path to automation. We optimized their channel level margins to offset host and processing fees. Many property managers experienced this when Airbnb changed their pricing model, right? Many property managers had to go back and adjust. This was part of that change, right? And we fixed the rules in their PMS so that the leakage could be stopped downstream. What happened as a result of this cleanup and reset is we were able to do a reliable monthly close and a consistent schedule, and their financial visibility was restored. The $50,000 of misallocation was adjusted, their channel margins were protected and started growing, and they were able to deliver owner statements in a timely and trustworthy manner, leading to fewer questions and more confidence. What I realized is they didn't need us more software. They needed the financial discipline that scaled with the portfolio. They need a close cadence. They need a clean trust account, and they need the visibility to margin that they could actually defend. So with that, what I want to say is clean books are a foundation. But then clean books don't tell you the full story. For that, you need to understand ratios and benchmarking. And that's where we lead to it as our next section of our of the webinar. We will be talking about ratios that matter and why you should be looking at these ratios. So I'll kick it off, and then Dan's going to add some critical elements here. But think about this, right? Numbers tell you the what, ratios tell you the why. So let's start with the revenue, right? Hey, common thing somebody says, "Hey, my revenue is up 20% this year." Sounds great, but are you adding units or are you adding value? So um, revenue per property, on the other hand, tells you the answer. If your revenue is up 20%, but you've added 25 or 30% more doors, then your yield per unit is down. That's not growth, that's expansion masking decline, right? Second thing, we talk about, hey, cleaning fees. We collected this much in cleaning fees. It sounds like income, but what did you pay out to the cleaners? The cleaning margin tells you whether cleaning is a profit center or a cost center. I've reviewed P&Ls where the operator was losing money on every clean and they didn't know it. The third thing is management fees. Hey, I hear property managers say, I've consistently made this much in commissions and management fees. Consistent versus what? The rent you manage or the market rate? So this is where a ratio like fees to rent ratio matters. It shows you if you're earning a fair share of the rent you manage, or are you leaving money on the table with every single contract. Finally, I think the most important metric is not just revenue growth, but did your ultimate operating net or net operating income margin improve? This shows you how much for each dollar of revenue is reaching your bottom line and fingers exactly which cost is eating into that gap. So this is a really important ratio also. Operators who grow profitably into the future always know their ratios. And the ones who don't, they find out too late. So our recommendation out of this is if nothing else, go back into your P&L today, take a look, calculate these ratios, try to get an understanding of your ratios for the last couple of quarters to see where these ratios trending. It's really important. It'll give you a deeper insight into how your business is running and how it should be running. One of the most important ratios, again, was talked about earlier, but I want to give the presentation back to Dan to talk a little bit more about RevPAR.
Sorry about that. Put myself on mute. The When we talk about RevPAR, it's more than just normal KPI. It's more than just combining ADR and occupancy. What this really helps you do is identify some other performance issues that are happening across everything in your portfolio. Particularly, if you have a property that has high RevPAR, but it has low profit, the problem might be more on the expense side than on the pricing side of things. Property level RevPAR really helps you create that operational insight where you can drill down into every individual property and see which properties have what RevPAR and then which properties are profitable and then combine those two. That weak RevPAR might signal a pricing or positioning problem. We've seen this come from different types of OTAs where you get bookings that don't make sense because their fees are way too high. Or where you book too big of a property at too low of a rate because you're not covering your cleaning costs, or you don't charge enough for your cleaning costs, excuse me. And so RevPAR helps you kind of tie all this together and see that um, when you match it up to your profit and loss statement.
Great. Uh, so Dan's already talked about RevPAR, which is the right metric, is even better than revenue per property. So I won't be focusing too much, but like if you're you must look at revenue per property and RevPAR, because revenue per property will just tell you how much you're adding more properties, are you adding more revenue. RevPAR will tell you why. Why is a property not adding, right? So if revenue per property, what does healthy look like if it's growing, right, year over year, with a tight spread across your portfolio, right? If what broken looks like is you're either trending down on revenue per property, or there's wide variance between all the properties and two or three of your top performers are carrying your entire property management company, right? So you need to look at them. But then if yours is broken, it might be a pricing, occupancy, or property mix problem. That's where the action is what already Dan said. Segment your portfolio by tier, market, and bedroom count. Diagnose whether it's a rate problem or a demand problem. And that's what key data's benchmarking and segmentation tools actually help you solve. So that's the best tool for fit for that. But then these other ratios are also important. The fees to rent ratio, right? Total fees divided by total gross rent. This is healthy for healthy ratio for a standard regional vacation rental is typically 18 to 20%. If you're trending below 15%, outside of ultra luxury or high volume portfolios where the market caps naturally compress commission rates, you're likely leaving money on the table or failing to charge for ancillary value. You need to benchmark against your local market to say, why am I that low if you are in that territory? Cleaning margin. Again, healthy ratio should be 10 to 20% or higher. Negative or under 5%, you're subsidizing the guest. Action there is to reconcile fees against vendor invoices for property, renegotiate contracts, flag units where the cost routinely exceeds the fee. This is the silent killer. I keep mentioning. Most operators have run this number, never run this number for their portfolio. When they do, and they get uncomfortable results, right? So it's really important for you to understand the cleaning margin and benchmark it. And finally, we talk about the net operating income margin. This is how much net operating income you generated on your operator's gross revenue, not on the what shows up in the trust or or what the fees you collect from the guest, right? This should be in the 25 to 50% range. And we have seen clients who joined us, maybe starting at 25 to 30, they've moved up to 40, 45% over time. So it is all about understanding it, measuring it, benchmarking it, and then constantly driving factors, tactics to behave, to continue to optimize and improve this number. So these four ratios, according to us, really matter. Again, RevPAR being a critical ratio to be able to understand revenue better. With this, I want to show you one example of a company that had grown significantly and had kind of lost the focus at the most granular level. So this is a client of ours, which is 150 plus portfolio. They could see the forest, but not the trees. They had a bloated chart of accounts. technically detailed, practically unreadable. They were trying to understand property level profit and loss, but it was so manual and it kept breaking. The in-house housekeeping costs were sitting in one big pool. There was no clean way to attribute them to individual properties. Most of their expenses or charges were not categorized well enough to be able to categorize at a property level. Some of the income was not being categorized correctly at a property level. So at they were at 150 plus doors, they were still flying on portfolio averages. Right? What we helped them, the work we did was in three moves. We redesigned their chart of accounts. We stripped out all the redundant sub accounts. We kept the granularity that actually can be helped to drive decisions. We worked with their tech partners to map every property to a QuickBooks location. So revenue flows directly into the property automatically, as well as all the expenses from the expense management system flows into the property automatically. And then we built a housekeeping allocation model that was used to allocate the housekeeping costs down to an individual property level, right? Using client defined rules. And the after of that was that 150 plus property level P&Ls are generated every single month. It was not possible before. It's less error prone, faster to produce. And the part that matters the more, the outliers get detected, right? So units consuming disproportionate amount of labor surface. And if they have a RevPAR problem, that's one thing, but they may have an expense problem, like Dan said, right? This property level P&Ls from the property manager's vantage point allows you to read that, right? So this company, they didn't need a bigger finance team. They needed the books to be rebuilt in a way that as a short-term rental operator, they could make better decisions by property and not just at a portfolio level. So this is the main lesson of all of this is you need to be able to benchmark, find the right benchmarks to look at your entire profit waterfall. You need to be able to understand these key ratios we've talked about. Sometimes it's all about setting the right foundations and connecting the dots to be able to get to these insights. But it's really important when you get the insights to look at them on a monthly basis and learn and grow. So that this is just the main lesson from these two case studies we've shared. Um, and with this, we want to jump into the key takeaways and open it up for questions. So, Dan, to you.
Yeah, and as you hear these, if you have any questions, we have one that we're going to come back to here at the end. But the if you have any questions, type them into the chat. We'd love to get to them here in just a couple of minutes. So just to kind of tie everything together, the revenue growth alone doesn't guarantee profitability. It's not just about adding more doors to your portfolio. It's about making sure they're profitable. In order to do that, we need to be able to segment the inventory really well and segment it in many different ways. That's what's going to help bubble up some of the opportunities within your portfolio. Then we want to use benchmarking to guide every one of your pricing decisions because at the end of the day, a lot of it does come down to pricing. When we look at that, we want to be able to understand what the market is doing so we don't outprice ourselves because then all of a sudden our demand goes away and then we have a whole different problem. With that, Vishal.
Yeah, I would tell you the main takeaways for us, it's always been through all the work we've done is it's a visibility problem, not a profit problem. Most operators aren't broken, their books are. And you can't fix what you can't see. So you have to fix your books if the books are broken. You have to put in that effort. Fixing the foundation is more important than fixing the dashboard. Most people are like, I need this cool dashboard, right? But if the foundations are wrong and the wrong data is going into the dashboard, it's not very useful, right? So categorization, trust separation, pass-throughs in the right buckets. None of the ratios matter if the books are wrong. So getting the foundations fixed. And then beyond the four we shared today, there are additional ratios but that may matter more or less depending upon your business. But the one key is not to just to use numbers, but to use ratios to understand why certain things are happening and asking the deeper questions. So just a point I want to make about understanding this at a property level. That's where the competitive advantage lies. Most operators can get a high level view of at a portfolio level whether they're breaking even or not. But understanding this at a lower, deeper level becomes a big competitive advantage. And we want to leave you that that's where you want to go. That's the direction you want to go. And with that, we would open up to questions that the team, the attendees have.
So the one question that, or the first question that did come in was going back to the very first slide. What on your presentation, Vishal, was the owners, cleaners, and TOT is paid through the trust account. That's the question. Is just wanted they wanted to verify that those
Yes.
three line items all go out of the
Yes,
trust
yes,
account.
yes. They should go out of the trust account. Trust account. Yeah, if you can, that allows you to for example, there's some gap rules around not recognizing revenue that you don't own, right? So some of this past, if you don't do it to the trust account and you're flowing it into your operating account and it's on your P&L, your revenue may be overstated, and you're actually that's not your revenue, right? It's the owner's revenue. So you'll be looking at like I'm only making a 5% margin on large revenue, but reality if you look at your operating account, you're probably making a healthy margin on what is truly your revenue. So it's important to separate those out. Great question. Great question.
If there's no other questions that come across here, I think the only other question that's in here is how do we hire host allies? So that's a nice layup for you there. If you go to the next slide, you can see how you can get in. Oh, wait, before we go here, let's go back to the question slide. What is paid out of an operating account?
So what is paid out of an operating account? Is that a general question? Just what is paid out of an operating account?
What is paid out of operating account? Correct.
Okay, great. So essentially anything that is not at a property level, but it is your overhead should always be paid out of your operating account. For example, all your labor costs, all the team that you're paying, their salaries, their wages, right? Any software that you're buying, any advertising that you're doing, any legal fees, any insurance to run the property management company. If you're paying for some accounting help, if you're paying for tech stack, all of that should always be in the operating account, right? What should be paid out of the trust account is important. It's only property related expenses, right? And if you're using a credit card, and the credit card is paying out of the trust account, then it's fine because the burden is falling on the trust account. Um, so try if you this is a more detailed question. I would love to have a maybe a one-on-one session to understand exactly what you're using to make the payments to explain this answer to you because the answer does get nuanced, but in principle, that's how you separate. Trust account paid for all the property related expenses that are owner charges that the owner should reimburse are all trust account and all the overheads sit in the operating account. That's the general rule. But there are some other situations where we have to be a little bit nuanced in terms of accounting for them.
Great answer. Yeah, credit card costs pay for both trust and operating is one of the comments that she
Yeah,
said.
and I think that's the question. It's like if, say, for example, you're using a system like RAMP, right, for expense management. There are ways to delineate within RAMP which cards are being used for the trust account related expenses and operating expenses. You have to do the setup correctly. But it is important. It's actually good practice to use separate credit cards because then one could be directly flowing into QuickBooks and getting categorized and the other could be being managed in your PMS or in your trust accounting system. So there's a certain things to think about, but yeah, there should be separate credit cards for running operations versus trust expenses.
Wonderful question. Wonderful question. Did not know that one. Well, let's go to the next slide then. And this is how you can get in touch with Michelle.
Yeah, I think there is my bigger picture suggestion to the team or suggestion to the group here on the call is um, getting to the right property level financial clarity is a little bit in putting the right dashboards and the right metrics. That's really important because if you don't have the metrics and the dashboards, right, you won't understand which direction you are, or where do you fall within if you benchmark yourself. But sometimes getting to that right answer, the dashboard is fixing the foundation. So HostAllies helps in both areas. We help clients develop the right trust accounting, financial accounting system with the right revenue recognition, expense management, and trust liability accounting practices, right? So that's one aspect of the help. And then all of that flows into the right benchmarking scorecards that we've produced, right? Which allow us to help understand where you are and how your performance should keep getting enhanced. But if you need some help just getting started with this journey and you want to get started, but you're not sure how to get started, then just send an email to hello@HostAllies. We'd love to offer you a free consulting session where we'll look at your books and understand where you are and see if we can help you, just give you some guidance to move forward, or we can actually help you make this transformation like we've helped so many other clients. Um, so looking forward to hearing more from the folks who attended. And with that, I'll hand you back to Dan to talk a little bit about key data.
Absolutely. If you want to get interested in, or if you're interested in joining the Key Data collaboration, we'd love to talk to you. You can reach out to us at sales@keydata-dashboard.com. I'd love to walk you through what's going on in your market, even if you're just a little confused about the situation that you might be in from a benchmarking perspective versus the market. Happy to jump in and show you what that looks like, show you the difference between what's going on the OTAs versus what's going on with direct source data. Happy to do that anytime. Just reach out to us, sales@keydata-dashboard.com. Thank you very much, everybody. I really appreciate all your time, all your attention. It's really cool to see 90% of the people who joined this call from the start. We're still on at the end. This is a very hot topic right now, and excited to see all the growth that all of you receive with the amazing insights from Vishal.
Thank you so much, Dan. I really appreciate. I learned a lot from what you presented. But if anybody needs any help, hello at HostAllies, or you can contact me at vishal@hostallies.com, and would love to engage and help you get it started on this journey towards financial clarity, visibility, and more profitable growth.
Thank you, everyone. Have a great day.
Thank you.